Last time I looked at the concept of following the crowd specifically in terms of trading and explained how this is a really bad idea. If you do this consistently, you're probably going to lose money consistently. But the majority of novice traders whose trading account balances constantly head downwards don't even know that this is because they are following the crowd. If you can recognize this in your own trading behavior, you can then start to do something about it. And that is what today's episode is all about. Back after this brief message. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. If you're a talented trader looking to attract investor capital to your strategies, Darwinex is the fastest way for you to do this. We enable traders to raise third-party investor capital and then charge success fees on high watermark profits. Additionally, Darwinex itself invests in its traders with our seed capital allocation program that allocates up to 90 million euros per year in successful trading strategies. So, if all of that sounds interesting, learn more by clicking on the link here, or you can find further links in the description right below. Now back to today's tutorial. So I'd like you to focus on the part of the chart between here and here. As you can see, we're in an extremely strong upwards rally, and if a novice trader were to turn their charts on at this point, they might look at this and begin to panic that the market's moving upwards strongly and they're not in a position. And what's going through their mind is that in order for the price to be pushed up so strongly like this, there must be a huge excess of buyers over sellers. And their psychology is telling them, get into the trade. All of these buyers can't be wrong. But the problem is, of course, actually the buyers started to get into the asset down here and then continued to do so all the way up. So anyone getting in now is actually late to the party. And this is what's known as chasing price. Now let's just change the scale on the chart a moment so we can look at what happens next. So let's imagine you've taken your position at this point here on the right. Now let me ask you a question. How many times have you entered a trade only for the price to turn around at almost the exact moment that you entered? It's almost uncanny. It's as though someone was waiting for you to place your trade and then told the market to reverse. But actually, it's not uncanny at all. This is a symptom of chasing price. And the reasons behind that is that if novice traders are attracted to some price action, the price action has probably gone too far already. In other words, it's become overbought. And when prices become overbought, they very often reverse their direction. And that's what's happening. Now, let's consider the second problem for a moment. Over-leveraging. Let's say that the trader was so impressed with this move in the market, they decided to break their rule about what their maximum position size and maximum risk would be. This is such a surefire winner that they decide to maybe put 4 or 5 times the position size on that they've previously decided they would. Now what this means is that when the price does reverse, as it did here, this really begins to hurt, and the losses on the position are growing and growing. And as the price continues to come down, eventually the trader decides that enough is enough and they have to get out of this position before it destroys their account. And this is where that irony comes into play. When you over leverage, you often get forced out of your trade just at the point that actually you should have been getting in to your trade. And the price turns and moves in favour of the position you were previously holding. And so let me ask you this question. How many times has this happened to you in the past? And actually, the reasons are the same, but in the opposite direction to the reason you got into the trade in the first place. Psychologically, sitting on this huge trade and watching the price action come down here eventually reaches what is a breaking point. And in your own mind, you think this price is just going to continue going down. But it's the opposite to what it was here when you got into the trade. And the price has, yes, become short-term oversold. And what happens when prices do that is that they often change direction and go the other way. Now, for quite some time, as a novice trader, what you're probably thinking here is that you just got unlucky. If only you hadn't closed that trade quite as soon, you'd now be in profit. If only the markets hadn't done what they did when you entered the trade and they'd carried on upwards. It was just unlucky. Well, it wasn't unlucky. The fact is, you got into the trade at the wrong time because you were chasing price, and you got out of the trade at the wrong time because you were fearful of the losses because of the over-leveraged position you had. Now, I can say all of these things because I've been here. I've lived through these kinds of positions early on in my career. And speaking to other traders, which I probably do on a daily basis, I know for a fact this is a mistake that many traders are making. So if chasing price is the wrong characteristic that you should be targeting, what are the correct characteristics that you should be focusing your attention on? And the answer to this question is going to be the focus of the next 3 episodes. I'm going to be taking a look at 3 of the most common price action characteristics that traders attempt to exploit. And I'm going to start off with the trading range and a mean reversion strategy. And as you see when I explain this next time, this uses principles that are the absolute opposite of following the crowd. So be sure to tune in to that episode. If you're not subscribed already, then click on the subscribe button below and you'll be notified when that episode is released. But now, until next time, trade safe.